So based off this big rally that we've had, we could see it pull back to roughly about 18 to a 24% pullback in the equities market. The gold chart is pointing to a pullback to about 3,600 to about 3,300. So it has about a maximum kind of 17% downside range from where it is. The monthly chart for Bitcoin points to 16,000 again, which is a target I had many, many years ago. And it hit that target based on a very similar chart pattern.
Gold, Bitcoin, stocks, or oil have the most downside potential right now, and why?
I would say
it's Thursday, June 25th. The stock market is relatively flat today. Gold is seeing a bit of a bid, up 1.5%. Bitcoin is slightly down below $59,000 a coin. Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com, is back with us to discuss market outlook. Welcome back to the show, Chris. Good to see you again.
Hey, thanks for having me, David. Always a pleasure.
Now, in 2025, the theme of our conversations was centered around how to outperform the market when everything is going up. Recall that the stock market was hitting new all-time highs. Gold and Bitcoin were both hitting new all-time highs. Oil was still low, around $60 a barrel at the time, before the Iran war happened. But the theme last year was one of euphoria. How do we stay ahead as investors and traders when everything is hitting all-time highs? The question wasn't whether or not to stay in the market. The question was what to pick to get ahead. Now, all those things have rolled over. Stocks have rolled over. The S&P has topped early June. The gold price has topped earlier in late January, and Bitcoin topped late last year. And so the question isn't so much how to get ahead by picking assets. The question is whether or not we should get into the markets at all. What do you think? I'll let you answer that question and start with the technicals. That's my preamble for today.
Yeah, I mean, you bring up some good points. So, I mean, I'm actually just working on a book right now called After the Rally. And it doesn't matter, if it's the equities rally or the Bitcoin, peak that was put in or the precious metals peak. It's how much, it's easy when things are going up, but how much can you actually keep and preserve after the rally? And that's what people, struggle with. There's obviously how to know when to trim, when to step aside. So, if we take a look at the stock market, I can share my charts of where we're at. I think the biggest thing here for viewers to pay attention to, and I'll try to explain, is I usually jump from different time frames, right? So it depends. If you're a long-term investor, you gotta focus on the long-term views. If you're a short-term trader, you just need to focus on my short-term views. But when we look at the stock market right now for where we are, we have the equities market starting to put in some really good volatility. We've seen some pops and drops. We're starting to see that volatility pick up. When we look at the market internals, if we take a look at the S&P 500, this is the daily chart, and the color-coded one on the right-hand side is starting to show these orange bars. This is telling us that the market internals, big money flows, sentiment is changing. It's going from green bars, which is big money's moving in, buying and holding, and now we're starting to see big money move away. They're looking for safety. And the last time we saw something like this, the market had rallied up, and eventually it kind of rolled over and said, hey, things are getting ugly, get out. And the market sold off. And so we're in this potential, this topping phase over here. And now we need to see which way this is going to break. And there's some really interesting indicators here, David, that are starting to show up. We're starting to see utilities come to life. When utilities start to outperform the stock market, it's a big red flag. We need to be aware that money's about to start flowing out of stocks, and we could start to see the equities market collapse. We're seeing the dollar breakout. That is a huge indicator as well, telling us, hey, people are looking for safety. Money doesn't know where to go. And so we're starting to see those things unfold. And so when we look at the market right now as a short-term trader, you just need to be like, okay, well, the market is actually in this potential little top, and it could break down and could have a sell-off. For a long-term investor, you got to look at this being like, okay, this will be a temporary potential pullback, and then it could potentially go a whole lot higher. So right now, as a short-term trader, from my perspective, we only hold the S&P 500. We actually closed out some of our position when we look at our S&P 500. We closed some out right up here near the peak, and we have a little bit left of that position. And we closed out all of our QQQ position. We actually closed the rest out right up near this high. So we are still long equities, but only with a sliver of our portfolio until the market decides it wants to go higher and gives us a clean signal, or if it breaks down, we're going to be looking for safety. We're going to be either sitting in cash earning interest, being able to buy back at a lower price, or we're going to look to where can we make money, which is what your question was, which could be the US dollar. There's an ETF for that we can take advantage of. Some people may play an inverse ETF. You could move into, potentially bonds may come to life. We just have to wait and see. But the trends need to come to an end before we jump ship. And the trends are still up for both the stock market on the long and short term. It's just we need to see which way it's going to break from this pattern.
You said you exited your positions near the top. How did you know at the time it was the top?
So we've got our strategy identifies certain thresholds, certain levels and price points where the stock market itself usually runs out of steam and will have some type of pullback. So we scale out as we go up. We had multiple different targets, and that was one of the key target levels. So that's how we gauge it. It's based on statistical analysis. What does the index do? How does it typically move over time? And so those are the levels that we start to trim off positions, knowing that whenever one of those levels is hit, there's a very good chance the market could just roll over. And so we lock in gains as it goes up. So for example, if we were to just look at this chart, right, we would be like, okay, we got in here and we took some partial profits. We took on the SPY, we took some more partial profits. Potentially we get stopped out if this rolls over, and we'll lock in the rest of the gains here. But if the market then stabilizes and starts to build a launch pad, we could get long again with the portfolio and go higher. So we're constantly scaling in, or we get in and we scale out, and then we reload again after each price pattern. And that's the joys of following price and using sentiment and money flows, is we know when there's a strong trend and when there isn't. And so it makes it a little more simple to navigate versus trying to trade the news or just pure price action. Pure price action is very dangerous. You need to know what the money flows are doing as well.
Okay. Well, at the time, you probably weren't aware it was the local top. You probably just looked at indicators and it showed you that it was probably time to take profits. Is that fair to say?
Yep.
Okay. Now you're looking at indicators. Is it telling you that we're bottoming?
No. Right now, the indicators are saying the trend is still up, but it's running out of momentum. It's losing its trend, and it's losing its buying power. So right now it is just saying, it's not saying it's bottoming. It's saying it doesn't know what it wants to do, right? And that's kind of how our strategy kind of works. When the market doesn't know what it wants to do, our system's generally moving us out of the position, lightening our portfolio, because it becomes closer and closer to a coin toss. I don't want to win on coin tosses. I want to win when the odds are dramatically in my favor. So right now it is just saying it doesn't know what it wants to do. As we can see from these charts, we've had some very sharp pullbacks, push to new highs, very sharp pullbacks, huge gaps up, big gaps to the downside. This chart is showing increased volatility. The bulls and bears are fighting, and that is just a sign that there's instability. And so the way I run a system is either the trend is up, or it's down, or it's in no man's land. It's neutral. And so right now it is in neutral, but because the underlying trend is still up and we're long the markets, we still have a small piece of it because it could resolve to the upside and continue to go higher. So it's not saying we're at a bottom. It's just saying it doesn't know what it wants to do.
One thing I've learned from talking to countless investors over the years is that people spend a lot of time searching for certainty, the perfect signal, the perfect entry point, the perfect moment to act. But markets rarely work that way. In fact, many of the smartest investors I've interviewed weren't successful because they waited for certainty or the perfect entry point. They were successful because they acted when they had conviction. And that's especially true when it comes to something like gold. Many people have followed the gold story for years. They understand the macroeconomic backdrop. They see why central banks continue to accumulate gold, and they understand the concerns surrounding government debt, deficits, and currency debasement. But understanding an investment thesis and actually positioning for it are two very different things. Today, more investors are deciding to take a closer look. Some are purchasing gold directly. Others are moving a portion of an IRA or a 401k into a gold IRA. That's why today I partner with Augusta Precious Metals. What I appreciate about Augusta is their commitment to education. They explain how their process works, answer your questions, and help you evaluate whether or not precious metals make sense for your particular set of goals and situations. No pressure, no hard sell, just information so you can make an informed decision. So if you'd like to learn more, visit lintrustsgold.com, link down below in the description, or scan the QR code here, or text LIN, L-I-N, to 35052 to receive Augusta's free information guide. Chris, the Bitcoin price, is that an indicator of anything coming up for stocks? I'm getting mixed messages on whether or not Bitcoin's a leading indicator. I think you've told me no before, but the fact that Bitcoin has already dropped more than 50% from its all-time highs, and now it's trading right below its critical psychological threshold of $60,000. I wonder if that already indicates that capital has flowed out of risk assets enough such that we could be seeing a bottom anytime soon. What do you think?
I don't think Bitcoin is near a bottom yet. One of the really basic, I mean, trading doesn't have to be that complex, right? Look at this green moving average. This is the 150-day moving average. If the shorter term moving averages stay above it and prices above it, it's sloping up. You're in a bullish environment. When it's all sloping down, you're in a bearish environment. When you're in a bullish environment, you have a series of rallies and pauses and pullbacks, and they resolve to the upside. In a bearish environment, you have a series of bear flags, drops, and pauses. And so this is based on the chart pattern. I just was drawing this morning. The next downside target for Bitcoin is $44,000. That will break this low from back in 2024. It will be a big cleanse. It's about another 17, I think, % haircut. And then we could probably see it put in some type of, the question is, does it put in a bear flag before going even lower, or does it carve out a bottom and go higher? So the daily chart of Bitcoin is very bearish. It is breaking down at this point. I mean, money has been flowing out of the crypto space for a while. We saw, this whole phase right here, David, when we take a look, this phase right through here, that is when gold and silver were rocketing higher. And it just goes to show that people in the crypto space and investing in general, but in crypto, you're going for performance, right? You're going for like quick retirement ticket. Like, it's big performance. That's what people generally are chasing for it. And as soon as something becomes shinier than Bitcoin, which, pardon the pun, was precious metals, money came out of Bitcoin and it just piled into gold. And so now we've got these other legs to the downside, which is more like people have rotated now even out of gold, and now they're moving into, Micron, and they're moving into technology, AI. So there isn't very much excitement. There isn't any excitement in the crypto space. It is completely in a bearish environment. People aren't excited about it. They want to be in precious metals or the technology space at this point. And so this is still telling us, I think, we're going to go lower. If the stock market does have a leg down, it is definitely going to help, I think, pull Bitcoin even lower. And the monthly chart for Bitcoin, I was drawing this morning, the monthly chart for Bitcoin points to 16,000 again, which is a target I had many, many years ago. And it hit that target based on a very similar chart pattern. So there's a lot of potential downside here for Bitcoin. When we look at this chart pattern, I had this previously. When we look at this pattern here, we had some low targets, 12,000. We also had a 16,000, depending on the intraday, the weekly chart, target to the downside. Well, this one here is pointing to 16,000 again, right? This weekly chart is a giant bear flag, and it's starting to break down. So there is a potential big unwinding in the crypto space that we need to be aware of. And I think the stock market, if it does roll over, is really going to pull this down. 44,000 is the next critical target for Bitcoin.
And for stocks, the next critical level for stocks?
If we take a look at the S&P 500, we can look at, we can use a few different levels here. Just based on this last significant run up, using a Fibonacci, grab the right tool here, Fibonacci retracement. So based off this big rally that we've had, this is the monthly chart, we could see it pull back to roughly about 6,000 on the S&P 500 down to about 5,500. And so that is from, the current price today, that is about 18 to a 24% pullback in the equities market. Now, this is a long-term monthly investor. That's a big, significant peak. If we look at it from a shorter-term trader standpoint, let's just take a look at this. If we take a look at this one from a zoomed-in perspective, this current leg, it is showing that we could see about to 7,100 down to about 7,000. So if the S&P 500 pulls back here, we got about a 3.5 to about 6% drop, and that'll be a healthy correction. That is a typical pullback within an uptrend for the markets. And then if it can find a bottom there, it might generate a new buy signal and continue to go higher.
Okay. So today, I'm just going to pull up this article here. Today, we have inflation data out for core inflation. So the core PCE consumption, the core PCE index showed a 3.4% gain in the last month. That is the highest since October 2023. So the Fed looks at this particular gauge as an indicator as to whether or not they should be tightening or loosening monetary policy. Now, I'm looking at the Fed Watch tool, which tracks the probability of a Fed rate cut or hike in any given meeting. And now the probabilities have slightly shifted after today's reading for PCE inflation. And it has now been actually the probability of a hike has gone down somewhat. That's interesting. It was at, so if you're looking at December, for example, there was previously a 10% chance that the Fed funds rate would stay at 350. Now it's at 20%. Regardless, there's still an overwhelming probability that there will be some rate hike by the end of this year. Chris, how do markets, especially stock markets, respond to rate hikes traditionally?
Well, if rates are going up, you can earn a higher interest with less risk. So that's what people see, right? So you could move to cash and earn higher interest without the downside of the stock market, potentially crashing and taking a huge chunk of your portfolio. So as rates go up, we tend to see the stock market want to pull back because money that is defensive and worried about its future is going to look for safety, and they might start to move some money out and go into some other type of interest earning payment, right? So if the rates are going to hold up or go higher, it is a little bit of a headwind for equities. There's no doubt.
The question is why, though? Why are we expecting more of a downside for stocks and risk assets in Bitcoin? I know I've pressed you on this before, but just because something has fallen already from its highs and shown weakness, it doesn't mean that we can't get a rebound right away and recover. So it's just a matter of probabilities, which is higher for the downside or the upside. And so ultimately, how are you assessing this?
Yeah, I mean, the reality is nobody knows which way the markets are going, right? And and I always have, as all your followers know, I always have a bearish bias. I always pretty much have a bearish bias. And that's just the way I've experienced life. I experienced the markets. I've been through a bankruptcy. I've blown up multiple accounts many years ago. So I always have this defensive look on things. I always want to know what could happen if this backfires. And while I always talk about it, it doesn't mean we're actually betting on a falling market. That's where so many people get disconnected. Like, Chris, I got out because you said the markets were falling or going to fall. And the perfect example is, like, I have been bearish for several years, yet we continue to be long and ride the markets to all-time highs. So overall, I have this bearish bias simply because I like to always have an exit strategy. If all hell breaks loose, I want to know I'm getting out without losing a limb and I'll be okay. But this market is very resilient. Who knows? This AI bubble, I mean, some people say it's a bubble, some people say it's not. It is a very convoluted bubble because there are huge earnings, right? These companies are crushing it in terms of revenue and all of that stuff. So how high could this go? This market could just turn around, today and start to go higher. And if it does, we'll eventually have another trigger to get back in and ride it higher. There's right now it's kind of a coin toss, a short-term coin toss of which way it's going to go, which is why our strategy has kind of thinned out our position, because we want to know which way this train is going before we commit more capital. So, I mean, if I had to bet on anything, I would say, the market is probably going to go higher from here once it flushes out, because we are in a strong bull market still. It's just the short-term technicals are giving us a pullback is coming. It doesn't mean it's going to be a 25% pullback. It just means the market needs to digest this recent rally that we've seen before it potentially goes higher. Okay,
Chris, the other indicators you're looking at, oil, the fact that oil has come down substantially, does that put a bullish bias on any of your forecasts?
No, not really. I mean, I think we've seen the Strait of Hormuz kind of premium, worked into oil. Now people have been digesting all of that, and now we're just starting to see, I think, long-term positions, people thinking this was going to last even longer. We're just seeing those positions unwind. I think falling oil definitely helps the economy. It'll probably help drop inflation or control it a little bit to some regard. But obviously, prices at the pumps don't come down. And this is the problem when we have these spikes in commodities and things like that. As we see, all these energy companies have all this oil, they instantly start charging more for it, even though it didn't cost them more. And so these companies have these huge earnings, all because they're already charging us for what they think price will be for oil in the future. And then, of course, they have these huge earnings and the stock market keeps going up. And it's happening. This cycle keeps happening over and over with stuff. The energy space is about 10% of post-tax, the average investor's money they put towards energy expenses. The biggest expense is food. It's about 40% of most people's after-tax money. And so we still are seeing groceries high. We're seeing you go to a grocery bag now is like $50 to $100. I mean, it's crazy. I remember a grocery cart used to be like $150 for a full grocery cart. So it's a lot of pain. Falling oil, it helps a little bit, but the problem is prices aren't coming down for anything. It seems like they're all up here and they're sticking for a while. So it's a big delay. Prices go up quickly, but they take forever to come back down, and they never always come back down to where they were.
Okay, let's go over a few theories I've heard. One of them is if something goes straight up, it must come straight down. Case in point, gold. Case in point, Bitcoin. Case in point, I was looking at the ARK ETF that I was talking about with somebody yesterday. Is that always true?
No, nothing is always true in the stock market. It can do whatever it wants. This is the ARK ETF you're talking about, the monthly chart. It shot up with COVID, lost its energy, fizzled back out. When we go and look at Bitcoin did the same thing. Bitcoin was a bit more of a controlled, it had some spikes and huge pullbacks, but the precious metal space had these. It depends on how they move up, right? When we look at these charts, when they start to go real parabolic, they don't always have to come straight back down, but in most cases, they come back down for at least half of the move. That tends to be the big scenario. We've seen this over and over again. When it becomes this euphoric spike move, we see a very sharp drop. You'll notice like this spike from back here in the 80s, it didn't come all the way back down, but it came back down a very good chunk of it. Like if you were to just box the low and the high end, it came back, a huge chunk of it and some. Emotional moves are usually wiped out. So whoever gets in late and buys into the feeding frenzy move, usually the market's going to come back down to that price and then usually go a little bit below it. And it's the same we're probably going to see with SpaceX. I've done different IPOs over my life. I've done a lot of different company placements, private placements. And it's funny, you get in and the stock price goes ballistic and on paper you've made a fortune. But by the time you can sell those shares, the prices come back down and is trading below the price you actually got in because you're not allowed to sell it. And so that's kind of what these spikes do. The first part of the move is legit. It's a real accumulation and stuff. The last part of the move, the parabolic spike, is the emotional feeding frenzy, the FOMO. And that FOMO section is usually wiped out. And then it goes a little bit below it to turn, even the early people who got into a loss until they can't take it. So spikes are dangerous. There's no doubt. You don't know where the peak is. And when it does peak, it drops quickly. And so you have to be very aware. Very small positions should be traded if you're ever trading a spike.
Okay, which of the assets we've talked about so far, gold, Bitcoin, stocks, or oil, have the most downside potential right now, and why, from a technical perspective purely?
I would say Bitcoin has the most downside potential. If we take a look at the Bitcoin monthly chart, this chart is pointing to a very significant drop. I feel like, based on what I'm seeing, it feels and looks like it's dramatically out of favor. People are kind of done with that train. The downside move, this sell-off and this bounce is pointing to 16,000, which comes back down to a previous low in 2022. So I think that has the most percentage-wise from where we are right now. I mean, we're looking at another 72% haircut from where it was. So that's the most downside. I think which one has the least downside is probably gold. I think gold is usually the slowest moving. If we take a look at gold, let me just pull that up here. The gold chart is pointing to a pullback to about 30 from where it is right now. The pullback is about 3,600 to about 3,300. So it has about a maximum kind of 17% downside range from where it is. So, and that's why I've always liked gold. Usually when I'm putting in big positions or even short-term trading positions, I'll naturally navigate to gold versus silver because I find gold is very predictable. I have a much higher win rate with gold. It moves slower, but I trust it so I can put more money to work. So a lot of people don't understand position sizing and things like that. People are like, oh, you need silver to make more money. I'm like, well, if silver backfires, you put a lot of money in it, you blow your account up and there's a higher chance of you suffering. I like slow, consistent moving things where I can dump in a lot more money and watch my whole section of that portfolio climb in a consistent rate in a much more controlled manner. So that's why I really like gold as both a long-term investment and even short-term trades. The discretionary side trades we've done with gold, where we played a couple of these big breakouts as extra bonus trades, we're just in gold, right? Very simple, very low risk, and a very high probability type of trade.
Okay. Well, something like gold that has historically fallen by the order of 50% from its top and hasn't recovered since for a extended period of time. I'm talking about 2011, 2012, and also 1980. The only time that I can remember where we had a bull market end in a consolidation and then another bull market was 2020, when gold reached just under $2,000 in 2020, consolidated. You see that flat pattern there in 2020, 2021, and then shot up to where it is now. In prior bull cycles, structural bull cycles that lasted more than a decade, gold has done the exact opposite, shot up, and then in a bout of volatility went all the way back down. So this pattern that has repeated over and over again throughout history, is the chart showing a technical, I guess, kind of repeat of that pattern right now?
It is leaning towards that. I mean, that's what happens after most big spikes, right? The market has two ways to try to get everybody out. The first one is if the market, the saying is, if the market can't shake you out, it will wait you out. So it will drop significantly, usually very quickly. Like these first sections, right? These first sections are going to try to get you out, depending on what you consider the first section. The market will try to shake you out. If it doesn't get you out because you're like, no freaking way, gold is going to the moon and the economies, the world's falling apart. I mean, gold always has had the perfect story. Every year gets even better. But if it doesn't shake you out, then it will wait you out. Eventually, you give up. You waste all of this time, right? Some decades in some cases, with no return and watching your money go down. And gold costs money to hold. So I think gold is potentially tuning to do the same thing. Now, do I think it is going to go sideways for 14 years? I tend to think not. I think the market could have a very big correction, stabilize, and then potentially rocket higher and head up to $8,500 per ounce. That would be the best case scenario, right? A quick pullback, it finds stability, something in the economy or currency blows up, and gold goes through the roof. Although I don't really think deep down that's what everybody wants, because obviously if gold shoots higher and something breaks, it's going to affect all of our lives and businesses in probably a much worse way than watching your account go up 50 or 100%. I really, things still come back down to, we want a really good life. So people are praying for, crazy high gold pricing. I'm like, it will mean life probably sucks. We're going to have some serious, even more serious issues than we have now. So gold is in the shakeout phase right now. And then the question is, how long is it going to wait you out? And that's why, like, we moved out of gold when it broke over 5,000. We moved out of silver at $111. And now we're letting it figure itself out, because I don't believe in holding something for 20, 30 years or even 14 years. I don't even believe in holding something for a year or two, waiting for it to turn around. A year or two, that money can go to work somewhere else and make us return on our capital versus riding it down and stuff. So that is where I stand apart. Is I don't fall in love with assets. I only love them when we're long. And the second they show signs that they're rolling over, we could care less. We step aside, go find something else. And so that is the part we're in now. The gold probably, if it hasn't shaken you out, you're going to hold on to it. You're going to have it as a dead investment for years until you eventually say, forget, I'm moving on, put me into something else. Or you just kind of waste those years, right, with no return until it skyrockets. And over time, you'll be right. The question is, what are you going to do with that money? Or do you want that money working for you over the next 2 or 3 years or 10 years, right?
Okay. What do you think is a long-term inflation hedge at this point? Everyone's talking about higher inflation expectations. The inflation print that I just cited this morning is indicative of higher inflation, even in the core PCE category, which is excluding food and energy. So even excluding food and energy, we're starting to see other goods and services creep up in inflation. So now the question is, how do we hedge against inflation? This was a topic that was on everybody's minds back in 2020, 2021. It's starting to resurge. So what do we do if gold is not the right play here?
Well, I think the key with inflation is to own assets, right? But here's where things decouple. Sometimes assets are a little overvalued, like gold was earlier this year. When something gets stretched too far, you've got to expect it's going to recoil and pull back. The only way to really beat inflation is to own assets that kind of go up with inflation, like real estate and the equities markets, all of that stuff. If you sit in just cash and earn your 4% interest, you're falling behind the ball. Now, making 4% a year is better than losing 40 or 50% of your money. It is a temporary play. It is a position. It is a very smart position when things are falling apart. Where do you go right now? I think we're still along the equities market here. So equities is a way to keep up or beat inflation. Right now for precious metals, I'm looking for them to find a bottom, start to turn up, and then you can move back into them. I think precious metals is a great inflationary play. I just don't feel like paying a premium when it looks purely like a premium price, like it was earlier this year. So the only way to beat it is to own assets. And that's why the rich keep getting richer, is because they keep investing in assets. They buy things that over time go up in value. The key is just not to overpay. The key is to pay fair market value so you don't have years of no real growth. And right now we're seeing that in the gold market. You just have to, step aside, let it figure out what it wants to do. But then you got to get back into metals. There's no doubt metals is a fantastic hedge and play. It's working itself out right now.
The gold miners, since we're talking about gold, so let's combine gold and stocks. So gold miners right now are having a bit of a bid downside as well. Now the sentiment for gold miners has been euphoric earlier in the year, and now it's on the other side of the spectrum, very dismal. My sentiment, is my read based on talking to people and also looking at indicators like the bullish sentiment index on gold miners. So tell us what the chart is looking at or looking like right now, Chris, and what do you think is going to happen next?
Yeah, it's very similar to gold and silver. This is the monthly chart that we're looking at, these big views. It is still showing that we're going to see a very precipitous drop in gold, silver, and miners. They're going to continue to unwind, I think. And, it's just part of the phase, right? It had a spike, as you mentioned, it had a spike. You should expect it to come back at least half of that, if not, a third of that move to the downside. So if we were to just look at the most recent big run up, it is saying we could see GDX, for example, come all the way down to 69. It could come all the way down to about 58. So from where it's trading right now, we could see another 20% haircut fairly easy for gold miners. Silver and miners move very quickly. They're fairly small markets. It's speculative, so people jump in and jump out very quickly. It's easy to chase it higher. It's also easy to quickly panic and get out because it has big percentage swings. So it creates a lot of emotions, and emotions create big moves in both directions. So I think miners are going to come back down and fizzle out for a while. And there'll be a time I think there'll be prime opportunity, but right now it's definitely out of favor.
Okay, very good. Chris, the other assets that you follow that you do like right now that don't think will have a short-term downside move or risks to the downside for now.
The only asset I like is the U.S. dollar. That's it. As a Canadian, I like to own the U.S. dollar. So if actually, let's just zoom back a bit. So this is the monthly chart of the U.S. dollar. I feel like the dollar is putting in, one of these types of bases. It's at an unwinding event. Now we've put in one of these bases, and each time we see a big leg higher. And so I think we are on the verge of seeing the U.S. dollar move up. So if the stock market gives us a sell signal here and potentially the next few days or the next week or two, if our trend strategy comes to an end, we could be looking to move into the US dollar in terms of there's an ETF for the US dollar index. UUP, USDU is another symbol. To get in, you can ride these up. You can see these moves previously when we came out of this type of pattern. 20% move, 20% move, and 20% move. Whoops, way up here. So there's quite a bit of upside. And so I think it's a great position to potentially be in. In 2022, we saw the US dollar rally through the window. The stock market went into a small bear market. The US dollar rallied like 18%. And the biggest pullback was less than 4% during that whole rally. What I love about currencies is they are fairly slow moving, and they have low volatility. And when the trend starts, it's usually a fairly strong trend. And the currency market's huge. It's about $9 trillion traded every day in the Forex market, whereas the stock market is only about 1 to 1.5 trillion traded. So the stock market's pretty small. And that's why I think you need to focus on the dollar as a potential play here. And when we look at the daily chart, let's just clean this up. You can see the breakout. We've got this rounding formation that the dollar has turned a corner. It's starting to break out. This is not a good sign. This is telling us that big money is looking for protection. They're moving to utilities. We're seeing real estate start to move up, real estate ETFs like the REITs. This is the problem. Like Wall Street, they don't take generally their money out of the stock market. They keep it invested, but they move to safer places. And so right now the market, big money is starting to move away from some of the risky tech stocks in growth, and they're starting to move into. We're seeing the dollar start to firm up this currency. We're starting to see utilities. Look at utilities. They've been on the daily chart here. They've built a little bull flag. They are up actually very sharp earlier this morning, but they're outperforming the stock market. And this doesn't look like a very sexy chart, but there's some tells in here that we've been watching saying that big money is looking for safety. Utility sector moves fairly slow. No matter what happens in the world, we still need electricity, running water. So, these tiny little things, these little nuances are the key to understanding what the market is thinking and doing, where the big money is flowing.
Now, Chris, I want to show you one more thing. I initially thought, let me just share my screen and then we'll close it off here. I initially thought that perhaps because it looks like the JPY, the yen versus the dollar, and the S&P have held somewhat of a correlation. People have noted this on social media as well, how the yen has moved in lockstep with the S&P 500. And then I thought, okay, well, maybe the DXY index, which is what we're talking about now, will have a similar kind of relationship. But no, it doesn't hold at all. The DXY has nothing to do with the S&P. So I was going to ask you if you think the dollar strengthening, does that mean the S&P strengthening? I guess the answer is not necessarily, but I'll let you answer that.
If you always base things off past examples, relationships, eventually they're going to break, right? They don't always work the same. That's why you do need to. Yes, I do think if the dollar breaks out, the stock market is going to sell off. We saw this in 2007. We saw in COVID. We saw the dollar take off. When there's a big economic weakness, we tend to see the dollar take off. But it doesn't mean it's going to happen. The key is to follow the individual asset. Each individual asset has its own personality and it does its own thing. It doesn't have a close correlation. And that's what I like about it. It has its own correlation. It does its own thing. It's a different asset class. It's a currency, right? So I like it. And you have to follow it on its own. I do believe the stock market will fall if the dollar rallies. But overall, you still have to navigate each investment on its own merits and manage those positions individually.
Okay, great. Chris, great update today. Thank you very much. Where can we follow you for more of your work and more of your updates?
Yeah, the best spot is my website, which is thetechnicaltraders.com. And if you want to see some market analysis of what's going on each day, you can go to my YouTube channel, The Technical Traders on YouTube.
All right, excellent. Thank you very much, Chris. Appreciate your time as always. Please do follow Chris in the link down below. We'll see you next time, Chris.
Thanks, David.
Thank you for watching. Don't forget to like and subscribe.